Good afternoon, everyone. This is Joanne Stevens, and this is our first call-in show of 2018. I want to welcome everybody, and I have a few announcements to make, and then we'll get into our topic for today, which is capitalization rates. What is the capitalization rate, and why does it matter? So before we begin, I want to remind everybody that the month of January, the start of 2018, we're going to be focusing on making our parks cash flow as well as possible and make them worth as much as possible. And so we're going to start with the basics, Real Estate 101 of the mobile home park business, which is what is the capitalization rate. Next week, January 11th, our show will be the title is 2018 Mobile Home Park Advance. We call our meeting, which we had our company meeting in December, and instead of a retreat, we call it an advance. And at that meeting, we set our goals and our budget for 2018, and we're going to share some ideas for increasing cash flow and making our parks worth more in 2018. The next week, January 18th, we'll be attracting tenants by going green. And January 25th, what is the value of my mobile home park? So that will circle back to the cap rates, which we're going to talk about now. I also want to remind people that the Louisville show, the annual Louisville show, is coming up in Louisville, Kentucky, January 17th, 18th, and 19th. So if you just Google Louisville Manufactured Housing Show, you'll get all the information and you can register online. It's a fabulous show. Also, I want to remind people that the 2018 Manufactured Housing Congress will be April 24th, 25th, and 26th in Las Vegas, and this year it'll be at the Paris Hotel. And so let's get right into our topic.
So we have some emailed questions in, and the very first is, I hear so much about cap rates. What are they?
Well, I think there's a lot of questions about the whole notion of what is a cap rate. And this is going to be very basic. I'm going to explain how a cap rate is calculated, remind people that what's happened in recent years, especially with mobile home parks, is that investors tend to look at just what is a cap rate, which is simply a 1-year snapshot of what a property is worth. So when we buy investment real estate, it's unusual for the investor to hold it for only 1 year. I mean, certainly there are times when people will flip a property, buy it at a low price, find a buyer that'll pay them a big price, flip the property, make their gain in 1 year. But generally, people hold investment real estate, such as the mobile home park, for 5, 10, 20 years and more. So let's start by understanding that a cap rate is a 1-year rate of return. So that's something for people to understand. The other thing is that a cap rate or capitalization rate is a way to measure what is the return on the investment, because let's face it, people buy mobile home parks or investment real estate not because they love mobile home parks, they buy them to make money. And so a good investor is measuring what that investment is returning. And we'll get into a little bit of the theory of why invest or why measure the cap rate or the capitalization rate. So the general, the definition of a cap rate is the return that is based on the real estate income, and it's divided by the operating expense, and we come up with the net operating income. So the net operating income is then divided by whatever capitalization rate you determine is the appropriate market capitalization rate for your property. And today in the United States, for mobile home parks, we're seeing cap rates as low as 4 and as high as 10 or even 12. But they definitely have come down. And that's another thing that I want people to remember. The lower the cap rate, the higher the price. So the price is, or the value is the net operating income divided by the cap rate. And we'll have an example up with the, on the YouTube channel. So just to make it a little more concrete and a little less cerebral, let's say your mobile home park produces a net operating income of $120,000 a year. That's a net of expenses, and the cap rate is 8. Your property is worth $1.5 million. Suppose the cap rate was 7%, your property is worth $1,715,000. So that's a substantial difference between a 7% cap rate and an 8% cap rate. But let's clarify a couple of things here also. And that is, when we're looking at what is the income, we're looking at the real estate income only. Now that could include if there's outdoor storage, if there's storage garages, if there's apartments on the property, a single family home, any retail properties, anything that is real estate, which is permanent structure, would be included in that income. If it's mobile homes that you are selling on contract or renting, those generally are not included. I know I see some buyers and even some appraisers and banks will go along with including some of that income, but generally the income is the real estate income only. And let's talk about the expenses for a moment. The expenses, when you're calculating your net operating income, would not include the interest expense. You know, if you have a mortgage or any debt on the property, you would take out that interest. Also, if whatever your depreciation schedule is, you would not include the depreciation. So that's something that's important for people to remember. So take out your debt or your payments and take out your depreciation, because those are things that aren't really part of an actual expense. And if you sell your park, the new owner, they're going to have their own mortgage and their own payment schedule, but that, and they're going to calculate that in a way that is not part of the net operating income. So that is the basic idea of what is the net operating income. I hope that answers our caller's question. Is there another question?
All right, next question up is, okay, I'm an owner. why should I even care what the cap rate is?
Well, that's an excellent question because the capitalization rates are primarily a tool or a measure of return on investment that is used by the investor and also by the bank and also by the appraiser. So those are the three people that care a great deal about what the cap rate is. They don't want to see a cap rate that is too low because that could signal danger, although we are seeing unprecedented low cap rates, and nobody seems very worried that they're quite low, particularly the bankers, who one would expect, if anybody was worried, would be the banks. But if you own a park, you are an investor. A lot of owners that I talk to, and I do a lot of market evaluations for people who say they don't plan to ever sell. They're going to run their properties for a long time, and then they're going to leave the properties to the kids. But you want to operate as an investor even if you're not going to sell, because one thing in life is we never know, and a concept of investing is that we operate our properties at all times as if we were going to sell them. And what does that do for you? It's going to help you to maximize your cash flow. If you were going to sell your property, do you think you would be operating it maybe a little more tightly, be putting a little more thought into what everything is costing to operate, and be looking for some efficiencies to make your cash flow better? One of the traps that brokers like myself see is when park owners get their loans paid down or paid off so they don't have that monthly bank payment to make. Every month it's pretty easy to get a little more casual about the expenses and to not be pricing out the vendors. What does it cost to remove the snow? What does it cost for insurance? And that can be, they're not paying attention to what the market rent is for their sites. So along with that, measuring returns, a good investor, whether they're going to sell tomorrow or they're going to never sell, a good investor measures the returns. Because another idea, along with the cap rate and the measure of return, is it's assumed that the investor has various alternatives that they could be investing in. They're not just looking at just one thing. And if you are a park owner who is thinking about selling or getting ready to sell or is under contract to sell, you may be assured that your investor is probably looking at other investments. Another thing to keep in mind with the cap rate is there's the idea of, what is your cap rate versus other investments. That could be other types of real estate. It could be investing in land where there's not much to manage. It could be investing in stocks or bonds. It could be just holding on to the cash, buying some short-term CDs or long-term CDs, which I hear people all the time talking about. They don't like that idea because they don't get any return. But think about it, unless you're getting a good cap rate, perhaps you would be better off to have your money in cash where you wouldn't have as much cash flow, but you also wouldn't have the work, the risk, and all the things that go into operating a park, buying the homes, and so on and so forth. So I think investors or mobile home park owners should put that into the mix too. Sometimes it's not so bad to have cash. We've also been in about 10 years of a rising economy. It hasn't risen every year, but it is rising. And some investors, and Warren Buffett is a perfect example of that. He usually has billions and billions of dollars just sitting, waiting for the right opportunity to come along. He'll wait years, before he will pull the trigger and actually buy a company or take a position in a company. So there's nothing wrong with having cash as long as you're looking for good opportunities. And maybe the park is your best opportunity, and it probably is. So measuring, that's why you should care about the cap rate. It's a way of keeping score, measuring how you're doing. And I would say for most park owners, it's enjoyable to see how they do from one year to the next. Is there another question?
Why are cap rates different from one park to the next? Wouldn't they all be about the same?
That is something that takes more thinking about and more explanation. But yes, they definitely are the same. And so let's start by, imagine that you had a park that was, I was going to say an oceanfront park, but I want to say oceanfront because in the last several years, we're all learning more about oceanfront properties are maybe going to be a little bit of trouble.
Well, what about a nice resort area park? A nice resort area park.
Okay, so let's say it's a park on Lake Champlain in New York. I don't know if there are any parks. There probably are. So that's a very desirable place. There probably isn't enough housing. There probably is not enough vacation housing. So that could be a pretty, one would assume that the rents would be maximum. It'd be different than having a park in a town of 5,000 people, for example. So that would be one type of park. And let's assume that we're comparing that to the other end of the spectrum, which would be a small park, say under 100 sites in a relatively small area, under 25,000 people. And let's carry that out even a little bit further and assume that the second park has private utilities, which most investors, when they hear the word private utilities, they will say something like, "Thank you very much. It's been nice chatting with you. We don't need to talk about this any further." What I'm saying is many park investors they're afraid of the private utilities because of the potential risk of having to replace those private utilities, and also under a lot more scrutiny from local and state government to maintain those water and sewer systems. And so the lake property in the high-end area with expensive housing, not enough housing, is that would probably sell at a low cap rate, meaning a very high price. And the other property, smaller market, private utilities would sell for a high cap rate. So in today's market, the first property, the high-end property, we might see that as low as a 5.5%, or 6% cap rate. The other property with the private utilities would be probably at least a 10% cap rate, and could be as much as 11 or 12. And why would that be? That's to account for the risk of having to replace those utilities. I want to mention a couple of ideas about the risk, which we've touched on here, and that is that the risk does affect the cap rates. The risk affects the cap rates, and in a moment we'll talk about the opportunities that affect the cap rates, because population definitely does affect the cap rates. And why would that be? Because we know from from the real estate business that population drives the demand for housing, and that means that there's going to be more stability and possibly even rising rents, which means rising prices for real estate. The other thing is the jobs. You know, one caveat that I heard many years ago, and I've seen it remain true to this day, is that the jobs drive housing. If you have a market where there's an employer that's adding jobs, or there's a number of employers adding jobs, you're going to see you're going to see more housing. And that's one of the differences between why there's more risk with the smaller populations. There tends not to be as many employers, not as many jobs, and so if an employer cuts back, goes out of business, moves the business, moves the plant, or whatever the business is, that ripples through the housing market. On the other hand, if you have an economy where people are adding jobs, companies are growing, new companies are moving to the area, that's going to generally cause housing prices to rise and rents to rise. Another, so that's the risk side and why we see the capitalization rate be different from a metro area as opposed to a smaller area. It's really the risk of what's going to happen with the economy and what's going to happen with the jobs. It's going to affect the rent, the stability of that income stream. So so the investors think about risk. They also think about opportunities, and when they see opportunities, that's going to cause them to see more, which is going to cause them to assign a lower cap rate to the property they're thinking about buying, or the market that they're looking at buying in. And so what are the opportunities that affect investors and make them want to pay more for a property? And one of them is low interest rates and the availability of capital. And today we are seeing a unprecedented, for this century, unprecedented low interest rates and unprecedented enthusiasm from lenders to lend on commercial real estate. That isn't always the case. Sometimes it's just the reverse, where it's easy to get financing to buy a house, but it's tougher to buy commercial real estate. So it's the two things of the low interest rates and the availability of capital. We don't see that in every market. And by every market, I mean different times of the market, not the actual location of the real estate. Another thing that investors see, and this probably speaks to more investors, are analyzing the demographics of the ages of the population. Is the population of the area growing? Is it decreasing? What are the ages of the age groups, what do people earn, how much housing is available. What they're seeing is the demand for low-cost housing. And that's something that is probably going to continue, even though there are starting to be articles in business publications about wages rising. We haven't seen much wage increase for quite a while from many jobs in this country. And the final thing is there's a limited supply of mobile home parks. What we've seen in the past 15 years is parks closing for various reasons. Sometimes in a metro area, there's a higher and better use for a park. Some parks get closed due to utility or infrastructure that is just not fixable, or nobody's willing to put the money into a property, and so the park more or less goes away. But certainly there aren't many new mobile home parks coming online, and we haven't seen parks being built in this country, or very few, for going on 15 to 20 years, ever since the financing went away.
Gentleman wrote in, I am absolutely tired of mobile home park brokers telling me to raise my rent. What are some best practices for raising the NOI? Please, please, stop telling me to raise my rent.
Well, I hear owners say that too. And certainly that's the fast, easy way to increase your net operating income, which is a way to make the cash flow better for your park and also make the value more. What brokers have seen in the past few years is that when somebody buys a park, they're probably going to raise the rent. So they don't want to necessarily buy a park where the rent is at the top of the market. They want some meat on the bone. In other words, they want to be able to raise that rent and improve their return. So what else can investors do besides raising the rent? Probably the thing that I've seen more park owners do in recent years is to buy homes, whether they're new homes or used homes, and fill those vacant sites. Either sell the homes or rent the homes, but get that lot rent coming in. The other thing that I'm seeing owners do is, if there's any extra ground, making some outdoor storage that they charge either their residents or just people in the town. Some owners will build storage garages if they have extra ground. For sure, passing through the water, sewer, and garbage, you don't have to buy water meters. That's probably the ideal thing to do, to sub-meter for the water and sewer, but you don't have to pass that through. And finally, just to be a good investor and to improve that net operating income is to just look for efficiencies in your expenses. Bid out that insurance. Take bids on the snow removal, the lawn care, any other maintenance items, and just look for ways to save money here and there, and over the course of a year, 2 years, 5 years, that will add up and improve your cash flow and make your park worth more. So I want to thank everybody for listening today, and we'll see you next week when we present our 2018 Mobile Home Park Advance. Bye, everybody.